So just when we thought we were safe last week with things recovering and looking pretty decent, they came after it one more time. We've got some inflation data last week, at the end of last week. And starting on Thursday, things just kind of hit it. So here we are looking at the sea of red in the markets. It is Monday the 13th, not Friday the 13th. I am your host, the Cowboy. This is Elliott Wave Cafe. Let's get started. All right, so welcome to, if you survived the day and you're here listening to this, congratulations. It's been, one of the, toughest days in the markets in a long, long time in here. And there was basically, nowhere to go, nowhere to hide with the exception of the US dollar. So if you're a holder of cash, congratulations. And you probably didn't feel as much of a pain as many traders felt today in all the asset classes. So you can look at the equity markets that came down, anywhere between 2.8 and, almost 5%. So you can look at Nasdaq 4.6, SP 500 down 3.8%, 2.7 on the Dow. The mid caps, again, very close to 5%, large caps, small caps, wherever you would look, this things was just a complete sea of red. A big day in the markets. Again, that's been started by somewhat of a more elevated inflation data. It wasn't as crazy as the markets seem to react in here, but must be something else going on that are really freaking out the markets. The VIX basically, shot out about 22.6% today alone at a price of, at a closing price of 34.02. So big levels in the VIX coming up into resistance. We'll take a look at some charts. The big story of the day were the yields that shot through the roof. You've seen, on the short-term yields, a 16% increase on the 3-month treasuries. These are levels that are, quite unheard of in terms of, the strength of the move just today alone. You can look at the 5-year, almost 7%, 10-year, 6.6%, and then at the end of the curve here, 5.35%. So yields moving higher. Continuing to pressure the Fed into raising interest rates aggressively. And the talk of the town today was that they will possibly raise with 75 basis points coming this Wednesday. And there was a story in the New York Times apparently where there was leaked that they will do that. So again, just markets maybe rushing to, out front the Fed here, like they haven't done so for the past 6-7 months already. So deep red in here. Staples were the cleanest dirty shirt out of there, only with about a 2.1 decline. Energy was the worst hit in here. You would see down about 5.2%, so even stronger than real estate, communication services, and technology. So, if you actually look at it, a bunch of these sectors were still fairly okay, if you can call it that. But I was talking about the shorts in energy for a long time, that they will come after this market and try to take it down. We were able to take advantage of some, good XLE puts that we started last week. I posted something on Twitter about it as well, and I've closed that position today for about a 280% return on these puts. I'm out of them. I'm going to look to possibly reshort them, but along with Oxy that we closed last week, and we have some other shorts as well. But just a little bit of a positive, let's say, into this kind of big sea of red, because everybody has been bleeding money here. So again, not a lot of places to hide. You look at the commodities in here as well. Let me just kind of see if I can get them going. What's going on? Oh, sorry about that. Let me go back. in here. So taking a look at the commodities, basically, yeah, DBC down 1.1%. Gold, I mean, you couldn't even, get defensive with gold. Oil, USO was more, more or less flat. So basically the sell-off in the XLE was due to a lot of the stocks that are making up that ETF, and those got hit pretty hard. But the oil markets, the oil was not really selling lower much today. I was expecting a little bit more negative on that, but it didn't really happen. Natural gas down 1%, and then gasoline came down 3.6. Silver and gold, just negative. So nothing really happening in there as well. Cryptos, just a bloodbath overall. Whatever this is on this market summary, it's not the worst that has happened. Bitcoin down almost 14%, Ethereum almost 15%, and you're looking at Monero even, which is one of the, the strongest in there, 14%. Chainlink, not that bad. So this one, we've been monitoring this in the program as well as being one of the strongest out there with Binance Coin and maybe Stellar and a few others that were not looking like they're declining too much, but still, nevertheless, a big story in here, especially with Bitcoin moving. I mean, stories about, Celsius blocking withdrawals and transfers and things like that. Then Binance came with, their, blocking of taking out Bitcoin, whatever the whole mess was again. So I think it's just a lot of fear. People are trying to get money off the exchanges. There's a lot of FUD, and Bitcoin is coming into some definitely interesting levels that we've been monitoring here. So it's coming into some longer term interesting levels, right? Towards the 20-week moving average. We've got a bunch of fib confluence of zones. I was talking in the video this morning, and things might look appealing, but we definitely need some confirmation from the price. It's almost like, you're stepping in front of a big, freight train that's moving, 200 miles an hour. So it's still kind of scary in here, but if things can stabilize, I think there might be some opportunities coming in the crypto land here. I wrote actually an article, if you want to, check that out on Substack. I'm going to put a picture here and the link to it. I talked a little bit about the end of the crypto winter, and I wrote that on Sunday, and here we are Monday crashing, 20% or something. So definitely, my timing here, it's probably off a little bit, but I think it's this capitulation moves that we're seeing is probably telling us that we're very close to an end to this sell-off. So let's jump and continue to take a look at some of these markets. One thing I wanted to show you is this dynamic yield curve. This is something that I've been talking about too, but it's been kind of all over the news today, and it's probably going to continue into tomorrow. You're starting to hear people talk about the inversion of the yield curve, and kind of how that will lead to a recession, and how it can kind of break the markets and create all kind of issues overall with price. The most important one in my view, it is the difference between the 2-year and the 3-month. That's the one that will that has to invert to kind of tell you that, yeah, for sure there is a recession coming. So far, this yield curve between the 3 months here and the 2-year, it's still steep. And the moment this one moves higher, then, we can have larger issues at hand. But it is flat. If you look at the shape of this yield curve going up to the 30-year, is pretty much flat. If I take this line and I drag it, you could see how we were steepening into this advance. And then as we're approaching the top, look at the yield curve with the first sell-off starting to flatten out, and it's rising, right? So all the interest rates are moving higher. And you're going to get an inversion probably between the 2s and the 10s in here, very, very close to that inversion. But on a shorter term, this is still looking pretty healthy. So we need those 3-month rates to move much higher above the 2 to really, get more confident that, there's something bad happening and there's a big recession coming. So for right now, things are, cracking and looking, like things might be nasty with the economy, but they're still, fairly okay. So the price action in the stock market obviously doesn't suggest that, and it looks like all hell is breaking loose. Here is what I wanted to show you on the yields in here. You're very familiar with this chart maybe, where you're looking at the whole yield curve across, starting with the 3-month here in green, and then you have the Fed funds rate in here, this kind of chasing the 3-month and the 6-month, right? 77 to 1%. You know, that's going to get taken up to 175, so it's going to chase the 3-month pretty quickly. That's what we're going to get probably on Wednesday. And there's still a lot of work to do before, you know, there is some kind of a normalization in here. You can see the 10-year, that's in the red. That's at about 340 at the moment. The 10-year is at 343. So we're very, very close to inversion between the 10s and the 2s. But the 3 months here, it's still just at 173. 10, and I mean, I'm sorry, the 2s are... let's see what the 2s are. Yeah, 2s are at about 340. So still a big difference between the two. So we're not inverting there just yet. But I mean, huge rise in the yields in here after they corrected for a little while. So I just kind of wanted to show you that. Here is the yield curve between the 10 and the 2s. Right now we're at about 0.03 in here, and the top is the 10s, the bottom is the 2s. So the moment this one pushes higher, we're going to get inverted. We already did that right back in April for a brief period of time. You know, here we're coming back again to see if we're doing it again, just to kind of spook the markets one more time. Here is a longer term look at that, yield curve where you've gotten, I mean, pretty deep in here before you had some serious recessions. So this one back from 2006, 2007, you saw you went to kind of negative 10 basis points in here. And right now we're still above those levels. So will they have a recession? Remains to be seen. We're only going to find out, I think, at the end of July, kind of what's happened in the second quarter. If we're going to have a second quarter of negative growth, that would be, a technical recession. So the yield curve seems to want it to kind of come into the negative territory. We'll see if that happens or not. Here is the spread between the 2s and the 3 months. Still very, very steep in here. I didn't put the recession in here, but I mean, you can see kind of what happened before COVID right there. You can see 2007, 2008. You can see, 2001. You can see back in the 90s in here. These were kind of major recession, preceding major recession in here. And so far, we're still positive on that. This is just a look at the 30-year bond prices continuing to push lower. I mean, we've broken what is this? A 40, if not, about a 40-year down uptrend, into bonds, down trajectory in yields. And, this has been destroyed. And right now we're not making higher highs and higher lows, but we're basically changing the trend. We'll see how long this is going to be sustained before the Fed will step in, and we're going to get into the next easing cycle, and these things will shoot back up higher. But that's kind of what's going on in the 30s. Here's what's going on in the 20-year. This is the TLT Treasury bonds, which start to look attractive for a lot of people. Now they're giving you, 3.4, 3.5% yield in here. And then this is the 710, 98.94. And then here is the 1 to 3 Treasury. This is basically, shy 1 to 3-year Treasury bonds in here. And then here's something that I don't know if I've showed you guys in a while, but this is the spread between the STIP, which is the 0 to 5-year TIPS bond. So this is a Treasury inflation protective securities, that you're buying when you wanted to get protection against inflation, and divided by the 3 to the 7-year Treasury bond ETF, IEI, and that's been going up and continues to push higher. Right? People prefer inflation securities rather than regular bonds. They continue to kind of get hammered. So, it's getting quite extreme. I have no data in here to show any more resistance levels. We stopped a little bit back in here, but we're continuing to push higher. I mean, almost looks like, you're in some kind of, if I were to count this, some kind of a larger third wave. Maybe there's a fourth and a fifth, and we should be slowing down in this inflation craziness in here. And then just a quick look at the HYG. This is the high yield corporate bonds continuing to come lower, and investment grade corporate bonds as well. So, guys, there is just, nowhere to hide pretty much. Let's take a look at the macro daily view in here, and just take a look at the SP 500. Big sell-off. I'm going to take a look at the counts, but basically our projected ABC move followed by some kind of another ABC up higher in here, kind of fell apart. This market just smashed it lower. We got, serious gaps happening in here. We might be in the middle of a larger third wave decline in here that's just probably just starting. I have really no way of counting this in any bullish manner at the moment. It is probably a 1-2 in here with a much deeper decline, short of this being some kind of a B wave of a flat with a C wave rally to come, but that's still gonna show weaker markets for the summer. So the moment we broke below these levels, things are not looking that pretty in terms of Elliott Wave counting. So we're going to continue to just kind of watch it, but there is not much here that can give me a positive vibe in terms of kind of how this price action looks. This 50-day moving average points lower. We're way below the 20-day moving average. We might stabilize for a little bit, right? But it could be just a small second wave pullback. So until we seriously get back above 41.50 in here, I'm not going to have a lot of bullish thing to say about this market. Here is the NDX also breaking lower quite aggressively in here as well, and very high and strong volume as well. You look at the Nasdaq Composite coming down. I mean, this is 4.6% just on the day. You're looking at the Dow Jones as well. I mean, these moves in here still look fairly corrective, right? If you watch from the highs to the lows in here, right, you don't have that, wave pattern that it's a clear third wave decline. So it's almost like it's the beginning of something, not the end of something anymore. Okay, because if you can't really count this as a third wave, you would have to go in a 1, 2, 3, 4, a very small 4 in here. So you could go 1, 2, 3, 4, and 5. That's in progress, right? You could maybe do that, but that would be still a very bearish signal, because after a 3-wave advance, you're still going to get another decline in the markets. So maybe for a shorter term, you're going to finish up maybe a 5th wave in here. Although the way this drops, it doesn't look like it's a 5th wave. It looks like it's got a third wave type price action. If you look at the sentiment and the capitulation, style decline that we're having, that might be, where everybody kind of throws their hands in the air and said, screw it, I'm done. It's a 5th wave, and you're pushing higher in 3 wave. We'll take a look at the counts. But so here's Dow Jones. I talked about that, and then Bitcoin. Here's Bitcoin with the big drop in here, right? 13%, 14% just on the day after this corrective pattern here kind of failed, and you have what you seem to be maybe a 1, 2, 3. Still another 4th and another 5th coming before you're trying to get a little bit of a recovery in Bitcoin. But I'm monitoring, a count here in the program as well, where we're looking, for some important, again, confluence zones coming here shortly above 20,000. But look at the volume on this decline, right? Could it be a big capitulation candle? Possibly. So we'll see how that develops. I talked already about bonds, so I'm not going to go back in there and talked about the yields. Here is the US dollar. This is the cash settle. I think, we went much higher than 105. I mean, not much higher, but I think we've gone about 105.12, 105.13, I think, on the futures on the dollar index. It just, I was ready to start to short the dollar again, but it gave me no proper response from a pullback in here, and we made new all-time highs in the dollar, which again, it's not a positive sign at the moment. So the dollar needs to cool off in here to relax the risk assets, and that might come. I mean, listen, if the Fed gets spooked by these yields and they're going to put a yield curve control in place, right, like it's happening in Japan, and they're going to cap the yields from going higher, I think it's a long shot that they're going to do that. Actually, you don't hear anybody talking about it. If anything, right, they wanted to continue to raise and raise and raise. But Bank of Japan is the only one that it's not raising the interest rate, right? They're actually capping the yields at 25 basis points on their 10-year. On the JGBs, and it's just they're like not biting this one. They're just like, screw it, we're not gonna mess with with rising yields and with an economy that's weakening in here. So we'll see what happens. But that would be one of the catalyst for a big short in the dollar if the Fed even hints to something like that, right? But they probably the rates, the yields haven't hit such a high pain point yet that they're thinking about it. So here's gold, not doing much, just a big sell-off in here in gold as well. Here's oil. I still think this is a big B wave in oil, followed by a crash in here. That's what I'm positioned for. I got some shorts in the oil market, and just continuing to look at this as not being able to travel higher. If you're going to get a recession and things are going to look bad for the economy, I don't see how oil can continue to push, much higher. So it could be a bigger discussion, but just in terms of the chart pattern in here, I don't think this is a bullish structure. Could be wrong. EFI in here, so the markets without United States and Canada taking another leg lower in here. So we'll monitor those on big volume, and then VIX coming back into some big resistance levels. You can see it in here. We're going to take a look at that as well, but it is up into the 35. So if they're cracking above these levels, and we're flushing and capitulating up into 40, maybe 50 VIX, that would create a larger third over third wave in the downside in the equity markets, and that means that could still be some pain to come. But if you were to take just a range in the VIX, if you got guts in here, right, these levels in here told you that it's a good opportunity to short VIX up into this range, back down to this range in here, which means that the stocks can rally shorter term and the VIX can come lower. So that's a long shot. By the way, things feel at the moment, but it could be a trade that could be working out here. So just the advanced decline line, I talked about this last week as well, that if we're not able to break this trend line in here, things could start to look really ugly. And here we are kind of pulling back in here. So this advanced decline line never confirmed the fact that the markets were rallying in here, and they just kind of stalled and then sold lower. So now we're coming back into this kind of channel, right? So we're going to be watching if this is going to do this, or if the market will start to kind of recover a little bit back in here. And that's it. There's nothing else into the slide. Let me go back at, oh no, actually this was the same. And I wanted to take a look at the volatility here really quickly. So here is where we are on the VIX, basically, which I've really touched on just a minute ago, with the markets moving lower. So you could see that VIX, it's responding pretty well every time you get these big spikes in the VIX. So I'm not ready to put a blue line just yet in here. I want to wait for the market to stabilize just a little bit in here. And what I would watch for, I would watch for VIX to come a little bit lower, like that, while the markets is making a new low in here, right? If that happens, that means just like it happened back in here, you saw how the SP 500 made a new low. VIX did not push to a new high in here, and that led to a 10-12% rally off these lows. I was looking for a little bit more, close to 20%. That never happened. We came back lower in here, and that's kind of what would be something I would look for, kind of how VIX would behave. And then take a look here at the volatility in the Nasdaq coming back towards 40, 36, big resistance line in here as well. Nasdaq making new lows. Similar story I would watch to see if this one holds at these levels and it doesn't respond with the Nasdaq, let's say, pushing lower still. And then volatility of the VIX is the one that encourages me a little bit. It started to push higher, right? But the rate at which it's pushing, it's still downtrending in here, right? So you're getting a push higher in the VIX, very close to these levels, right, that you had back in here. And the volatility of the VIX, it's not really exploding. So it doesn't mean that it cannot happen. Obviously it can, but here you are in the VIX. Here where was the volatility of the VIX was back then, right, which was pretty high. Then you dropped again, and now you're dropping even more. So it could be the latest coughs of this VIX and this latest capitulation into the markets before we rally. But that's just that's a long shot again, and I don't want to price is price, and we're going to respect it. But it's something to definitely kind of keep in mind and look at this as maybe a contrarian indicator. I haven't taken a look at the put call ratio in here. I don't have this ready for you guys today, but I will definitely check it out maybe in tomorrow's video. So with this, let me jump over, take a look at the counts. So this is my Motive Wave platform. Taking a look at the S&P 500, we were looking basically to see if we can get an ABC advance, right? We looked at this as an ABC decline for a possible W, right? Or for an end to, let's say, maybe a second wave, followed by a much larger rally upwards. And I've said until we're breaking about 46.39, that big confidence, it's not really there. You're going to have to take those levels to start to believe that, the markets have found a low and you're about ready to move in the next impulsive move higher. And I was looking, to see if we can get a possible A wave in here, followed by a B and a C wave, attack this trend line, and then see if we can continue upwards. Well, the markets didn't even give us that much. It just gave us, a little bit of a push here, which could have been part of a flat. So I'm going to delete this ABC, and I'm going to take it off the map. Yeah, let's just kind of take that off, right? And you can have basically, if it's a 1, 2, 1, 2, that means that this move in here could be a flat, and you're looking at this as an A, B, because this move in here was pretty impulsive, 1, 2, 3, 4, with maybe with a truncated fifth in there, right? And this could be a flat. Now, if that's a flat, that means that it's either, a second wave, or let's say a fourth wave of, actually cannot be on the leading diagonal because those are zigzags. So it could only be, let's say, wave 2 at the lower degree. So you would go 1, 2, 1, 2 in here, and now you're beginning a 3, 4, and 5 lower like that. Okay, so 1, 2, 1, 2, 3, 4, 5, which means, right, that this still has a lot to travel all the way to 3,400, maybe even 3,000 in the S&P 500 over the next, couple of months. I thought I was trying to count this as a 1, 2, 3, 4, 5, and I'm not sure. I think was that on the Nasdaq? That I was trying to do that? Yeah, maybe, because this is we don't have overlap in here. So, if you wanted to take something maybe positive out of this, you could maybe look at this as a wave 1, 2, 3, 4, and 5. And since I have no overlap here, let me double check that. Otherwise, the software will say something. No overlap between the 4 and 1 in here. You could even have this as a flat, which is fine. So let's say 1, 2, 3, 4, 5. Let's say a leading diagonal in a wave 1, up in 2, down in 3, up in 4, down in 5. Since wave 1 is the longest, wave 5 would have to be smaller. If you want to look at it as a leading diagonal, you could, but you don't have actually the overlap. So the only way that could be maybe in the S&P 500. But let's say that you're getting a leading diagonal, kind of what's happening next, right? That's the leading diagonal. You're going like that, 1, 2, 3, 4, 5. Then you're going to get an ABC pullback, and then all hell breaks loose one more time, because what follows up, that's a motive wave, right? And that's either an A or a 1. And then you're going to get a 2 or a B, and then you're going to get a 3 or a C to the downside. So it's not really encouraging, no matter kind of how you look at it. So the only way this would look encouraging for a bullish narrative would be if this would be wave C off a flat. But there is just nothing here that tells you that I'm having an A, B, and then down in C. It's just so screwy that doesn't really work out. So this would be the better scenario for the markets moving forward. Let's say that you're getting, and under the circumstances, wave 1, let me measure a fifth wave, 5e3. So that's 5e1. I want to do 5e3. So 5e3 will have to stop short of 9,900 on the Nasdaq 100, right? Because that's where wave 5 will be bigger. If it passes that level, will be bigger than wave 3. And usually you're not really getting such a big wave. Usually you're stopping at about a 618. So maybe, we can stop back in here 10,972 and then try to create, an advanced higher if this is a fourth wave. Let me see what the pullback was. 4v3. So that's 38%, right? So that's, not a bad not a bad thought here that this could be maybe a fourth wave, right? And then you're getting a fifth in here, a little bit sharper, and then get an ABC. Now, if that's the case, how would that look on the S&P 500, right? Because that would have to recover as well. This market won't just recover on its own. So this is basically the shinier scenario, because you can get a nice recovery in here, right? That could give people a chance to maybe, clean up some of the levers that they have, or maybe get out some of the stocks they don't want into the next ABC move. But then the other one, it's that, 1, 2, 1, 2, 3, 4, and 5, right? That's the big bearish bet on the markets. Now let me go back and take a look at the Nasdaq in here. I'm sorry, at the S&P 500. Oh, before I do, let me take a look at. I'm gonna get rid of this. Come on. In terms of the correction overall, we're coming back into 38%, pretty close to 50. That's at about 10,500, right? So if that fifth wave wants to travel a little bit lower, that would be a 50% retracement. And then you would get probably a big resistance, big support level if you're ever going to drop here towards 94.18. But that would be pretty painful. So let me go back, and I'm going to close with this because I'm already past 30-minute mark. The S&P 500 count, right? So if it's a fifth wave, then, we're just beginning this crash. 1, 2, 1, 2, 3, 4, 5, 4, 5, and it's going to be, a big mess until the end of the year. If it's, let's see in here, let me go to a daily, right? If there is a way to anticipate that this is some kind of a fifth wave, I'm going to delete this, and let's look at it possibly as a leading diagonal, right? Like we've done over in the Nasdaq, and that would be, I'm going to have to get a leading in here, so that would be a wave 1, a wave 2, a wave 3, maybe a wave 4 in here, and then a wave 5, right? I don't like, you're not really supposed to have flats inside leading diagonals, so you're supposed to have kind of zigzags in here. That's why this would not fit the rules, because you're going to have a flat in a wave 4. That's usually a zigzag in there. So I'm going to go ahead and place it back in here. But this would be one way that this could be, something that could lead to a recovery, let's say next in the markets, do a correction in here in some kind of an ABC, something like that. All right, so 1, 2, 3, 4, and 5 in here. And again, you want this, hold on a second, let me see. You see, we got a problem. Houston, we got a problem. Wave 3 is bigger than wave 1. So that cannot be a leading diagonal, okay? Because in leading contracting diagonals, wave 3, it's smaller than 1. Wave 5, it's smaller than 3. And that situation is valid in the S&P, in the Nasdaq. All right, let's take a look at that in there. No, because this one we didn't count it as a leading, so that doesn't matter in here. But in here, it's a problem. So what are we going to do with this count? See, it doesn't work because of the larger overlap. I can tell you how it can work, but that's not going to be a leading. It could be if this was a wave 1. See, I already get a sign in there. So I'm going to delete this up. Let me try this. I'm going to do this live, so hopefully you guys get something out of this. So maybe a 1, an A, B, C for a flat in 2. Then you get a 3, 4, and a 5. Get rid of that, right? And this is, let's say, the first initial impulse. Because now, if that wave moves higher, on this wave 1, right? You're not overlapping. Could you argue this for a flat? It's, you can have like an, because it's got to be a 3, 3, 5. So you got to have a 3-wave move in here. So let's go ABC for A, ABC for B. So it's an A, B, and then, very awkward 1, 2, 3, small 4, and up in 5 for C. That would be an ABC inside a wave 2. So just a correction here, like that one, A, B, and then up in C. So, because you can also count this 1, 2, 1, 2, and then you're breaking lower. But if it wants to be like that, then, you know, this would be kind of how you would get a fifth wave into this move, maybe one more push lower. You know, you'll look for some kind of an equality there between wave 5 and wave 1, which comes in at about 36.83. That would be a fib projection right there. Maybe, you know, what's going on in here, you have a wave, you know, you have a wave, a 4 forming out of this decline, and a 1, 2, 3, 4, and 5. So one more triangle in here, maybe a drop lower into the Fed announcement, and then, you know, a much larger rally here in ABC. Everybody thinks you're going to new highs, you know, and then you're basically crashing lower again. So guys, listen, it's very hard to be bullish right now. If it's a reason to be bullish, it could be for a kind of shorter time frame. The other way we could try to look at this is, you know, is this a complex correction, right? In an ABCX ABC, that's another scenario which I, you know, just kind of coming to me as I'm looking at it. Like a W, X, Y. Yeah, this would be one way to be bullish, you know, and I'm going to kind of close off with this. It would move this higher. This would be a second wave, and that means that still forms higher. Let's see if that could be the case in the Nasdaq as well. Not as clear in here. Let me go to a daily. So you go, you know, you can do an ABC X ABC. Possible. It's a possible double zigzag. So I'm going to close on this very positive, you know, note. I'm going to do some alternate counts in here, and next time I present this to you, I'm going to have them on there. Basically, that's what we're looking for, right? A, B, C, X to the B wave top, then another A, B, C. And you can have a big complex correction and you're moving higher. But we won't know until, you know, you're starting to kind of get back about these trend lines in here and start to, you know, take over some of the swing levels, right? It's a lot of work out there. If you like this video, don't forget to give me a thumbs up, you know, leave a like, leave a comment, come and visit me in the pro room, trade with me, see what we're doing. And I appreciate you being here as always. I'll talk to you later. Bye-bye.